Hello, and thank you for joining our market outlook for the month of August. I'm Valerie Leonard, founder of EverThrive Financial Group, and these videos are a way for me to provide you with the most informed, unbiased, and unfiltered information on what you need to know as an investor. Third quarter feels very much like a transition quarter so far, with tariffs and DOGE news dominating first and second quarter market headlines. And that was the same time we were seeing decelerating inflation and growth. Now, though, it seems like we may be shifting to some potential light at the end of the tunnel thanks to tax cuts, possible rate cuts on the table, and then lower fuel costs. So, with growth seemingly accelerating again at the same time as inflation, that may be setting the stage for a continued bull market run. But the future won't come without market volatility. So, let's jump into 5 things investors need to know this month. Here's a quick look at what we'll cover today. We're going to do a little myth busting on gold as an asset class. We're going to talk about AI and the overall market trends. And then we'll wrap up with the latest on interest rates and tariff news. First of all, is gold a solid investment? We get this question a lot. There is a popular belief amongst many professionals, even in the industry, that gold is a safe haven asset, a good hedge when the S&P 500 is falling, and immune to inflation or political instability. However, gold is more volatile than people think. Why is that? Well, the secret lies in the reason behind an S&P 500 or stock market slide. So as you can see in this chart from the first column and the last column, gold has historically been a strong safe haven asset when the S&P 500 falls due to macroeconomic news such as data releases, as well as international trade policies and also terrorist attacks. Gold is not typically a strong safe haven when the S&P 500 falls for numerous other reasons. That includes political transitions, government spending, policy reasons, and then also monetary policy. Macroeconomic news is the most common reason that the S&P 500 falls, which is partially why the safe haven story developed. But we've also experienced S&P 500 drops this year with reasons that make it a weaker bet. So as always, it's best to speak to a professional advisor about your own personal situation and portfolio before investing. But these are just some good things to keep in mind. Second, let's talk about AI and investing. So in 2024, 1 out of every 3 venture capital dollars went to an AI startup, and the number is closer to half in the United States. Many of you remember the dot-com boom in the late 90s and the internet bubble that burst in the early 2000s. And there are indeed returns likely to be found in AI investments. But just keep this recent history and that dot-com boom and bust in mind. And of course, be careful about speculating in companies just because they're new and shiny. Recently, I attended an event where we spent a lot of time talking about AI, and there were business owners in the room from all over the world. It was a really interesting conversation. And as we delved deeper into the applications and the implications of AI for our own businesses, what we found was there's still a lot of reason why we need to go back, make sure our employees are embracing AI, and make sure that we are remaining competitive on the world stage. Because if we don't embrace AI, we're likely to lose our competitive advantage. So all that to say, we're looking at what rate are businesses adopting AI? Are they, using it widely? Are employees getting on board? And for the most part, you're seeing a lot of employees use technologies like ChatGPT, but not necessarily other AI technologies. And so I caution you that when you're thinking about using AI specifically for your own investment, purposes, maybe you're looking for investment guidance on your portfolio, just keep in mind that a common misconception is that AI is updated in real time. And large language model platforms like ChatGPT have what they call training cutoffs for each new release. So this means that you may get outdated information when you're typing into a prompt. So just take caution when asking for any market, investing, trading advice in AI platforms. They can and do make mistakes. Third, jumping into market performance. My outlook is still bullish on what's ahead, given that the trend is still very much our friend at the moment. You can see this chart just does nothing but go higher with periods of volatility and very real volatility at that mixed in. But overall, the trend is positive at the moment. So because growth appears to be accelerating, this means we're seeing a shift in what's working and also what's not. Historically, in an environment where growth and inflation accelerate at the same time, the best equity sectors can be riskier assets like technology or commodities, industrials, financials, and also consumer discretionary companies. But on the flip side, asset classes that are lower risk, maybe they're dividend related or they're defensive in nature, those have historically been the worst performing when both growth and inflation are accelerating together. And this is a big shift from earlier this year. At EverThrive, when we actively manage investment accounts on behalf of our clients, keep in mind that we like to underweight areas that we think are going to underperform in the coming 12 to 24 months. And then we also like to overweight areas that we think may overperform over that same time period. So this is important to keep in mind when you're thinking about the future, even if you have a long-term outlook overall. Fourth, there's been a lot in the news about interest rates and the debates between Fed Chairman Jerome Powell and President Trump, especially after the July Federal Open Market Committee announcement that would hold interest rates steady. So Trump has threatened lawsuits against Powell. He's pressuring the Fed to lower rates. But when you move beyond the headlines, the market is currently signaling a potential rate cut in September. July payroll growth came in under forecasts. And then May and June numbers were revised downward, which signaled that there is weakness in the job market. And as a result, analysts are predicting a high chance of September rate cuts, and also a cut in October is probably looking more likely as well. The resignation of FOMC committee member Adriana Kugler is likely to tip the scales towards a more dovish Fed shift going forward. And also, don't forget that Powell's term ends in May of next year. Now, the flip side is that we've recently seen disinflation in shelter and fuel, but then core goods inflation in food and medical services is definitely ramping up. So if inflation continues to trend higher overall, the Fed will be in a delicate balancing act when it comes to future monetary policy. I do see politics entering into the equation more than usual in the coming months, so it remains to be seen what the Fed will do in September or the remainder of 2025. Fifth, after multiple delays and extensions, tariffs originally announced in April have gone into effect for many countries this month after the president signed an executive order announcing the updated rates. Now, he's given China an extension until November, and he recently reduced tariffs on India to 25%. But outside of these call outs on this chart, you're going to see the tariff rates for each country as well as its share of U.S. imports. As of August 7th, Yale's Business Lab is projecting the average effective tariff rate to be 18.6%, and that would equate to a household income loss of about $2,400 in 2025 here for every household in the United States. So what does this mean for you as an investor? The price of goods is likely to increase, but the impacts of tariffs are not likely to be immediate, and global markets are currently at high levels, even with existing tariffs in place. So you may feel that the tariffs are going to hit your wallet, but there's no need to panic regarding your investments in the markets. As a matter of fact, international markets are doing quite well. And as always, we will keep you informed. We covered a lot today. We appreciate you being here with us. Thank you so much for watching and subscribing to our YouTube channel, and we will see you next time around.